Hi everyone. Today is Thursday, May the 22nd, and this is the Moneyball Morning Report for the Benzinga Pro platform. We begin taking a look at the E-mini S&P. As many of you who look at the market and maybe watch Bloomberg television or anything else like that, can't bear to name some of the others. Bloomberg is about the top of my threshold for television, as most of it's very annoying. But we learned yesterday at the 1 p.m. bond auction, we had a gigantic spike in the rates. Bonds fell. Remember, as bonds go down, yields go up. The higher a yield is, the more difficult it is on the market. So there's sort of a reflexive move downward. Now, I was on Lunchbox Trading with Deanna and Gabe yesterday on Top Step TV, and we were talking about this kind of move and what tends to happen in the first place. And so when we have, here's something super interesting. The longer we compress in a space and reduce the range of motion, when we have a range break, it's much more likely to continue. Doesn't mean it won't bounce, as it did, but that bounce really ends up collapsing most of the time at the prior support zone. And you'll notice that's exactly what happened at 5,892. And now we are getting dangerously close to the range break that occurred on May 11th on the tariff news. So it is my suspicion that bounces will continue to sell here in the broad market because this bond business is a little bit systemic. It's not quite like, hey, here's a tweet, things are going pretty good, or whatever the case might be. Now, last thing I'm going to say about macro is, a lot of folks are talking about debt to GDP and how we're going to fall off a cliff and XYZ. Listen, Japan has had an incredible debt to GDP ratio for, 25 years, right? Now, they did live in a lost decade. That's the term. But this notion of debt to GDP being the collapse of everything is a narrative. So let's just think about that for a second. Don't put all that big macro business into the market and immediately go, oh, okay, well, we're going to the floor and we're all going to live in a van down by the river. It's just not going to happen, okay? And if we do have trouble, it's going to be a slow, grinding, awful mess because we're going to use financial engineering to try to fix it, okay? So that being said, let's take a look at what happened. Yesterday, right at about 1 o'clock, and I mentioned this in yesterday's video, and I'll be a monkey's uncle if 1 o'clock rolled past and I totally forgot. I did not set an alarm. I knew the 20-year auction was going to be a problem, and I missed a ton of this move, a ton of it. So, that being said, a little disgusted with myself, but you got to have a golfer's memory, right? On to the next shot. Okay, so what are we staring down? Implied volatility to the upside is 5,902. On the downside, it's 5,816. Notice the weekly implied vol move is down here at 5,825. My suspicion is people are going to think, hey, this happens every time. We fail, and then we're going to bounce. So there are going to be a lot of people thinking this is a buy the dip event. I'm really not one of those people. However, we could potentially have a long that takes us up over 5,876 and back into this 5,892 and then potentially 5,902. Certainly that could happen. Anything can happen in the broad market. We know that. What we've seen, the hourly range is about 14 points wide. It's not much different to yesterday's opening Globex formation. And what we've done is sit right on the top of this area, right here at 58.65 or so. Notice, this is the zero line of the low to high structure event that the market's trying to hang on to. So we break structure. So what's the trade? Well, either we get back up inside structure and then we go to 59.02, or we break down structure and we go to 58.25 and 58.16. Here's the problem. If we're intraday trading, we could get chopped to ribbons right here. Absolutely chopped to ribbons. If you want to test it, you have to go to prior highs that have some convergence on the space. So we see that's about 58.77. And as long as we stay below 58.77, we're going to fall right back into the base of the opening range. Obviously, if something comes out and they make a comment, Scott Bessent comes out and he says, da-da-da-da-da, whatever, what we're going to be able to see is a very likely reflexive bounce, but there's a systemic event going on in the bond market, and that's where we're going to see the challenges forcing momentum and trend to the downside. Tech, big tech, performed all right, but they have a lot of cash on hand. Little tech, gonna be in trouble, okay? Everything in the RTY is very likely to break down because they're very interest rate sensitive. Okay, I know I wasn't supposed to talk so much about macro stuff, but that's it. What is the trend? Down. What is momentum? Flat. And that's because we've been literally sitting here for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 15 hours, right? Price compression leads to price expansion. We are very likely to move out of this range. Which direction? I have no idea. But what I do know is if I get above 58.77, I can potentially be long, according to the structures, into 58.92 and 59.02. If I break structure, which is the low of 58.51, or I get back in the opening range and break below this shelf at 58.61, I can potentially go short and get to 58.51 and finally 58.25. All right, let's take a look at the NQ. I'll go much faster here. I'm not going to talk about macro anymore. Okay, what's the trend? Flat. What's the range? We're still bound sideways. So tech, because it performed the way it did yesterday, looks pretty good. Certainly looks better than the ES that we just stared down, because the ES is inside its opening candlestick formation, and the NQ is at the top of this area. So you might say, hey, can I take a long at 21,171? Of course you can. But trend is down to flat, and momentum is flat. So it tells us we've got sideways motion. When you've got sideways motion, it's better to look for the 50% range to consider going long, and that puts us at 21,140 or so. So you got about 40 NQ points before you say to yourself, wait a second, can I take this short or no? Can I take this long or no? All right? If we lose 21,113, the low of yesterday is 21,070 something. Okay? I believe bounces are going to be sell zones. If we had a tighter moving average, we would see that trend being down, momentum being flat. We've got sideways motion. What do we have? Jobless claims or something like that? If that comes out wonky, we're going to have some issues. But bounces are sell zones in this formation, right? Until we recover above the moving average, we've got a problem. Super trend, downward formation. So I like sell the bounces. All right? Just going to have to be careful. Watch your size. Look for the wicks. Wait for your price. Here's the YM. Looks much worse than the others. Okay? Remember, foreign divestment moves into the YM first. So what do we got? What's the super trend? Down. Are we under the 63? Yes. What slope is that? Down. What's momentum? Flat. So everything's down. Momentum is flat. So it tells us we're going to have candlestick retracement in a grind to the south. As we take a look at the YM, what are we staring down? Notice, if you're thinking about taking a short, your stop is going to be 42,048. Okay? You could use 42,000 even, but it could wick up into this area of known congestion. All right? 41,835, buyers are going to have to defend that zone. 41,835. If we can hold that area, you can trade from the bottom of the opening range to the top of the opening range, but you better compress to a very tight time frame to make sure, 1, you stop heading lower, 2, you go into resistance, 3, you pull back and you hold support. Now, that's already happened here, so you could say, hey, if it comes in and tests 41,835, I'm going long and I'm going to leave myself a 30-tick stop. Right? That's fair. But you got to get out because reflexive bounces here, though possible, are not really going to give you pure direction. I still believe bounces are sell zones. All right. Now, last time we were down here, we bounced like a mad beast. I think people are going to be looking at this and they're going to go, oh, look at that. That's perfect. Da, 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 da. I'm buying the bottom. They're going to do that. I do not believe it's going to hold under the systemic structure event that happened yesterday with the 20-year bonds. I just don't. Lower edges of the range, 41,673. That's a lower target for a short. Consider the short again at 41,926. Stop, 42,038. So that's a lot of range. You just want to be careful. See the buyers starting to come in at that base? They're going to do it. They're going to look at this and go, oh, look, I'm buying it. I think it's a short duration. If I'm wrong, we'll breach that 42,000 and we'll stay there. So I know where my trade event is going to be belly up, as they say. If I'm trying to short this, it should not get over 42,000 or I'm done. So I'll wait at 42,000 for the short and make my stop tight. It could leave me behind, but I'm willing to take that risk, not chasing the trade. Okay, so let's have a look-see. Micro Bitcoin through the roof. It was insane. But it fell just like the other markets. It just recovered very quickly. So the question is, what gives? What's going on here? And so my thought is this. Let's establish, what's the trend? It's up, right? What's momentum? It's flat. The implied vol move is 596. That we already breached and we're underneath it. So what's the trade? Well, this one's a little bit tough. I got to tell you, I was waiting for this short and I just sized up a little bit too big in my Top Step account. I left it alone in my other trading accounts. Beautiful short, boatload of cash. This was the implied vol move from yesterday. I said, you know what? I think they're going to reject it today. And then the bond news came in and it came right into my target, which was the high of the Globex Open of the day before. Okay, notice where it stops. At the low of the Globex Open of the day before. Pay attention to this 1 hour. It is huge. It's huge. So, dips are buy zones here. Trend is up. Momentum is flat. The super trend is also up with support down at 108. Now, traditionally, Bitcoin does whatever it does, right? Last couple of days, it's been running with the market. Yesterday, it took off and ran without the market. And so there's a pretty big bid in here, but we are coming dangerously close to the 2-week implied vol move. And so folks that are short these options are going to have to do a little neck stomping, or they're going to be really upside down and we're going to hit 114,000. What's my thought? I want to see it fail to hold 110,500, and then I'm going to consider the short down to 109,000 and then to 108,000, and then I'm going to get out, right? But for right now, dips or buys. We're at the top of the range. How long does the buy go for? Well, if it stops dead and it can't get up over 111,600, you want to clip the wings on that long and let it do a mean reversion, come back into the moving average. All right? So, targets above 112,000 to 114,000. Longs ideal at around the break of this congestion zone. That's at 108,350. I don't know if the markets will give us that, but I expect they do. We'll just have to see. And that's all we're staring down. If the market catches a bid, Bitcoin's going to catch a bid, right? Bitcoin's going to catch a bid. And liquidity, everybody's expecting liquidity to get pushed into the market, and they're not wrong. They really are not wrong. Interesting days ahead. Let's take a look at oil. Hourly chart in oil. It had a massive opening range yesterday, collapsed straight to the base of that opening formation, and then bounced and failed, right? That's how we look at a move, right? If it fails, it could do two things. It could look below and return, or it could retest the area and fade. And this is what we're looking at, right? Oil coming down. This is the weekly implied volatility this morning. It bounced right off of it in the 7 o'clock Eastern time candlestick formation. And now it's up above the daily implied volatility, so it's stretched its band. Most of the time in oil, when it comes down into that weekly formation, the band will stretch. If oil begins to rise, the bonds continue to fall, the market is going to feel the pressure of the weight, and it's going to likely fade. But since oil is in a bounce zone, we've got to look at what the chart is saying. What is trend? Looks pretty flat to me, right? Could we have a structure break right here if we're staring down a wave formation? Yes, right? If we, instead of that wave, we measure the wave down here to the high, the low of May 15 to the high of May 20, what we're seeing is a structure break. 50% mark, not until $62.36, right? $60.23, implied volatility move. They're going to try and bounce. You've got to look for a formation that, 1, fails to hold lower, 2, tests resistance, and 3, does not break the low. Guess what we just did? We broke the low. Trend, it's flat, but it's also down. What's momentum? Pretty steeply down, particularly on the hourly. So bounces are very likely to fail until they don't. What we want to see is structural holding of the $60.23 event, at which point we can take the long, potentially at 60.50, and ride it into $61.17. What happens if we recapture $61.34? Well, we've got to ride up to $61.56. Okay? So, what's a person to do? Wait for the structure to tell you which direction to go in. If you look at this and you go, but Henry, if I waited for that structure, I would have to wait 1, 2, 3, 4, 5, 6 hours to get the long entry, right? Fails to hold lower, tests resistance, pulls back, holds a higher low. You could say, yeah, that's true. You could also watch for it to stop heading lower, break resistance, find your floor, and then go for it. It's just the amount of risk that you're willing to take in the trade. This suggests to me that there's a bounce action play in here. There is. So I would not be considering a short until the retest of the high congestion zone, which is about 61.56. That's almost $1 away, right? That's almost $1,000 on a CL contract. Your choice. Higher edges, $62.53. If we lose $60.23, the next fly in the ointment is $59.88. Let's check out gold. Okay, gold also having a bit of a reflexive move yesterday. Interesting, right? This 12 o'clock candlestick retraces, and then the 1 o'clock candlestick, as bonds go down, yields go up, that normally will send gold further to the south, right? Right? If bonds and gold will normally move in the same direction, because if yields go up, then I'm making more money from cash rather than gold. So that's not always true, right? This relationship moves all over the place. But what are we seeing today? We have an opening range that, it's less than $10 wide. We expanded in the overnight right into the volatility expected move. 3,342. 3,347 is either the high or low of an opening candlestick formation. Clipped it and then began to rotate down. So where do you get involved in a trade like this? How do you look at this and go, uh-oh, that's topping? Well, first, it's the implied vol measure. So you go, all right, let's see if we break through it or we move back into the range, right? We can go from the top of the range to the bottom of the range, from the bottom of the range to the top of the range. But the failure here, price tells you first that you've got a short. Trade it down, loses the opening range low, $3,316 or so, and then it's in absolute continuation until what? The expected move for the day, expected move for the week. So I would not be surprised if gold tried to bounce and stay inside of this zone so that the traders who sold the option on the edge down here aren't going to be caught flat-footed. Because if they do get caught flat-footed, gold's going to rotate all the way back down to 3,248. I do not know which way gold is going to go. It's moving in a bit of a frenetic pace to the upside. That's all I can say about that, right? High edge, once again, 3,342. Low edge, 3,287. So where's the trade, Anne-Marie? Well, we just started. Fails to close lower. Now we're testing resistance. So could it just, boom, move all the way up? Yes, it could. So collapse into a tighter time frame so you can establish risk. If you take a long right now at 3,300, your risk is literally $20 wide. That's huge. That's a lot. Okay? So you want to be careful. If you're trying to do something like that, you could get chopped up a little bit trying to get in here. Just watch the rotation. Remember, fails to close lower, bounces into resistance, pulls back and holds a higher support. That gives you a region that says, I can enter here and my risk is here. Can I accept that risk? Yes, I'll take the trade. That's just the X, Y, and Z of it. All right, here we go. SPY. Very tight to opening range. A little bit tighter than yesterday's, but very similar to the day before yesterday's. Here's where I think SPY is going. $578.20. Why? Expected move on the weeklies, and it's the top of the gap, right? I expect we fill this gap. I really do. I expect we fill the gap. What is trend? Up, and now they're searching for support. Because it's broken the 63. If we had a tight moving average here, it would say, oh, that's bearish. What's momentum? Flat. So what does this flat-ish momentum say? That we will grind in the direction of trend with trade formations that pop into resistance and continue to sell down. Remember, trend is master and commander. What's the target on the low side for SPY? $579 to $578. What's the upside target? Let's say you're one of those people that's saying, listen, this is buy the dip. They're trying to scare us. Everything's going to pop up. If you get up over $584, your stop, $583 and some change, and you can ride it up to $586 to $588. I think this is a systemic break. So we're going to have to see how the bonds react in this particular environment. We want to see if they're really going to be aggressive to force Scott Bessent's hand in order to bring down, order to get the Fed to do something else, right? Scott Bessent comes out, and then the Fed goes, holy cow, we really got to do X, Y, and Z, blah, blah, blah. There's a lot of moving parts. Okay. Lastly, we'll look at the Qs, and I know I have talked your ear off this morning. I am so sorry. There's a lot to talk about. Notice Qs have stayed right inside, right in the middle of their volatility moves. This morning, however, did I get this right? No, I didn't move that down. Hang on 2 secs. Knucklehead Fred here. 4. What's that open? So it's 510. Okay, so the expected move here, and this one is 18. Okay. The expected move gives us a low end of $510.45. Where are we? Underneath the opening range. Filling the gap, right? What's over here? Market structure. Look what happened the last time we broke it. Bounced. Nowhere near the 50% line, which incidentally is also the implied volatility move there. So the fade here sends us into support at 512. That's the bottom of the range. And then 510. I believe this notion that tech being a good place to hide, no. People are actually thinking, don't worry about it. We're going to buy the dip. We're buying the dip. It's don't fix what ain't broke, as they say. But this is kind of a big deal. So we'll see what's going on. If I'm wrong, we will break $515 and we'll run up into $518. That's why we have, hey, listen, if it breaks the ledge, you have to consider longs into resistance. And if it breaks the ledge, you have to consider shorts into deeper support. And the weekly vol move for the Qs is, $505, which is pretty far away. Hey, take care of yourselves. Watch your risk. Let the market tell you what it's doing. Use price first and indicator second. Price first, indicator second. Take care, everybody. I'll see you on the streams.